And we're back with our weekly energy update with Dan McTeague, president of Canadians for Affordable Energy.
Well, thank you for that, Nima. Again, a very interesting week. What hasn't been an interesting week in this past year, at least as far as energy futures and prices are concerned, what could have and should have been an increase, given the tentative deal in Washington over the debt ceiling, turned out to be quite a remarkable retreat. Again, as I've mentioned many times, Nima, the market is not the way it used to be. It's very dysfunctional. It operates based on the whims of short sellers who we've seen these folks act in the stock markets on other products, AMC and whatnot, and meme stocks. And we saw the effect markets fighting back on that. Sooner or later, reality will have to kick in. And that reality is that we are seeing a world that is increasingly short of supply, certainly the second half of 2023, which we are in now, and a market in which the demand is still very strong. Go figure. These lower prices are, in fact, encouraging demand. And although the data is sometimes murky and it changes and has to be updated, there is no one out there that is suggesting that markets have not picked up. And where they have not picked up or are perceived to have not picked up, there's significant evidence of stimulus by the government. I'm referring, of course, to China, which earlier this week had manufacturing numbers which weren't exactly optimistic. And yet we see demand in that country for oil breaking through all-time records. So sooner or later, reality is going to have to hit. And that hit is, of course, going to be borne on Canadians who, in the past week, have seen about a 5-cent decrease. In my neck of the woods here in Toronto, we were 166.9 last Saturday. It dropped to a full 9 cents a litre. I think that is a question of the product being oversold, especially given the fundamentals. And so I think for next week, we can see prices starting Saturday moving up anywhere from 2 to 5 cents a litre as we head towards next week. And of course, this weekend will be important because it's OPEC's meeting. And while there are people on one side that say, oh, they'll move to a production cut, which they did just a month and a half ago, others saying don't expect anything, some even suggesting there will be a production increase. The reality, I think, is more somewhere in the middle. And that's that led by OPEC, there will be a requirement that the cutbacks in production be mandatory, not voluntary. And so that means a message directly sent to Russia in its ambitions to pay for its war in Ukraine, that OPEC is pretty much becoming very tired of this. And the risks for Russia are huge. They've engaged in a war in Ukraine, which they are not winning. It's a protracted war. It's a costly war. They can't afford to see oil prices drop even below the sanctioned level. And so for that reason, I suspect that what we're going to see come this Sunday is a move at the very least by OPEC to make those cuts formal and rather than voluntary. And what that will mean is that inevitably, as we go through the summer, every single day, the world will be short 2 million barrels. The United States cannot come to the rescue, nor can other OECD nations that are part of the International Energy Agency's group of countries with spare barrels of oil through their strategic petroleum reserves. The U.S. foolishly abused it to try to control price. It sold a lot of that to the United States, to Europe. And more importantly, it sold the kind that they desperately need. That's heavy oil. That's the stuff from Canada that the Biden administration refused to allow itself access to. And so the U.S. and the world global markets on energy are in a bit of a pickle. What that means, look for a 5-cent increase to the 193 range in Vancouver, 174 to 175 for the rest of BC. Look for Alberta to remain in the $1.38 range, 5 cents cheaper, of course, in Edmonton versus Calgary. Saskatchewan and Manitoba, where the retail margins and the refinery margins are extraordinarily generous, as much as 30 cents a liter. We should see an expectation there at some point of prices dropping, unless, of course, they want to continue to, as it were, line their bottom line with gas prices that don't reflect reality. It's a bit of a hit at Saskatchewan and Manitoba prices because I think they're extraordinarily elevated. In Ontario, look for prices to get back up into the low 160s, up about 3 or 4 cents a liter. Same for Montreal, into the $1.74, $1.75 range. As for the Maritimes, they will potentially see a 4 cent decrease, followed very quickly by a 3 cent increase. All in all, perhaps not much movement next week as their regulators contemplate what the price ought to be to create that sort of synthetic market from the real market. goodness knows why they do it. I think free markets should be allowed to make those decisions to benefit consumers in their region of the country. That's it for this week, Nima.
And that was Dan McTeague, president of Canadians for Affordable Energy, with Forum Daily's weekly energy update.